What's up? Coach B here with another episode of Chalk Talks. And while I promised we were going to move into option strategies after the Greeks, there's one more video I thought might be worthwhile making before we do. I made a video recently about one of my options plays and how I'll be rolling my calls out to a future date. And I got a ton of questions about how that works or why. So before we touch on actual trading strategies, I figured we should start there. First off, one important thing to note. When you buy or sell an options contract, you do not need to hold that contract to expiration or even exercise your contract. In fact, more often than not, it's more profitable to actually exit your contract well prior to expiration. Basically, three things can happen when you open an options contract, right? Number one, the contract expires out of the money worthless. We don't want that. Number two, the contract expires in the money, at which point some sort of trading of the underlying stock will take place, right? Like you're either going to exercise it or you're going to have to sell it depending on if you sold it or bought the calls or puts or whatever it may be. But something's going to happen in that regard if it expires in the money. Number three, you can close the position early. Okay. And I know I've seen a lot of people throw around the number of only 7 to 10% of options actually get exercised. And that usually brings about the myth that basically 80 to 90% of options expire worthless. That's not true at all. While it is true that around 10% get exercised, typically almost 70% of those options are closed out before expiration, leaving somewhere in the 20% ballpark that actually expire worthless. Obviously, these numbers will be different based on the underlying stock and many other factors, but those rough numbers usually hold true. So, closing an options contract for profit, to me, this is what I'm almost always do. Rarely do I enter into an options trade with the intent to exercise it at expiration. Why? Because as we've talked about in previous videos, options contracts contain time premium, right? So that's that value when they're doesn't even have to be in the money, but they hold this value of time premium, and IV and everything else that plays into that. But basically, if I can close out a contract for a profit ahead of time, while it's giving me way more profit than the underlying stock is worth, why wouldn't I? So let's do a little example. Let's say I bought a contract on the $12 strike for a $10 stock, right? So $2 out of the money, 20% out of the money, and it's for 6 months from now. I might have paid $2 in premium for that, meaning I paid to get, I need the stock to get to $14 at expiration to break even. $12 strike plus the $2 that I'm paying for it. So I got 6 months. I think this stock's going to get to 14 bucks to break even. So now after a month of holding the contract, the stock has a 15% move and it's trading at 11.50, 50 cents away from my $12 strike with 5 months left in time premium. And IV is spiking tremendously because we just saw this big run up, right? Well, my contract premium might be worth, I don't know, $6 suddenly. That's a 300% profit. I paid $200 for the contract and it's trading for $600 right now. Now, if I hold this thing till expiration, I need the stock to get all the way to $18, right? To get the same return. It's a $12 strike plus $6 per share. So I'm going to need this stock to go all the way to 18 to get that same 300% if I was to hold this all the way to expiration. Now, this is where, so basically it'd be more beneficial to me right now. I could sell this contract while the stock's trading at 11.50 and get that same amount of profit out of it. Okay. And this is where rolling comes in. When you roll a contract, essentially all you're doing is closing it out, selling it, I'm done, and buying another contract on the same stock. It could be for the same expiration, but at a different price, a different expiration at the same price. It doesn't really matter. It just means I'm closing one out. And opening another one real quick. Like I'm rolling it. I'm saying, okay, I'm done with this contract. I'm going to open up the same contract on the same stock. Okay. Some brokers will actually handle rolling for you, but I usually just do it manually. So why would you roll? There's so many reasons, and I'll get into more depth on those on when it makes sense to roll in other videos about certain strategies. But, for example, one reason I always roll is to take profit. Like the example I shared above, if all of a sudden my calls are up 300%, at the $12 strike, it's really easy for people to say, like, okay, well, I still think this stock's going to go up, so I'm going to hold longer. Well, like I said, now you need the stock to go all the way up to $18 to see that same 300% gains if you really plan on holding that long. So, I bought those calls for it's a $12 strike. I bought the calls for $2, but now they're worth $6. I might want to roll up to a higher strike price. So I could sell the $12 strike that's trading for $6 right now, get $600 back in my pocket, then turn around and let's say maybe buy the $15 strike for $2. So, my initial $200 investment turned into $600. I sold it. I'm now going to buy the $15 strike for $2, $200. That allows me to put $400 profit in my pocket, okay, while still maintaining a bullish position on the stock. I still own calls in the stock. I still feel like the stock's going to go up, but I already took some profit, and I still hold the same position. And I have no intention of actually exercising these anyways. I just want to profit off the movement and the volatility. Now, sometimes you may decide to roll because you really think the stock is going to keep moving, and you're not ready to take profits. So in that sense, maybe you just want to roll out. Okay, so the other one we rolled up, now we're rolling out to a further date. So again, using the same example from earlier, we have a stock trading at $10. I bought the $12 strike. Okay, but now the stock didn't really move much. Now let's say a month, 2 months, 3 months, whatever goes by, and I only have like 30 days left on my contract. And maybe the stock's trading at $11 and we're getting close to expiration. So I paid $2 for this contract and now it's worth $1.80. I'm still bullish on the stock. I still think the stock's going to move up, but I want to give myself more time, right? So now I'll sell my contract for $1.80. Yeah, it's a loss. But then immediately buy the $12 strike still, but buy it for another 90 days out. And that's basically going to give me like 4 more months for the stock to move because I think the stock's going to move. So basically what happened here, I sold the contract for $1.80, got got $180 back, but I'm buying this contract further out, let's say for $3. So I'm paying $1.20 more, $120 more than I initially intended to. But I'm giving myself more time because I'm still bullish on the stock and the movement I'm expecting hasn't happened yet. Okay, so that would be an example of rolling out. Like, I'm going same strike price, but further out. Anyways, just another quick video. I wanted to kind of throw this out there because I really feel like some people thought that when you buy a contract, you want to hold it to expiration. And while that could be the case, if you plan on exercising, there's many times, like I said, probably 9 times out of 10 for me, that I don't plan on exercising at all. And if that's the case, you do not want to hold till expiration. You want to sell well ahead of time. Take your profits, move on to the next play, or roll like we just talked about. So if you're enjoying the videos, please hit the like and subscribe button. Also, if you have ideas for future videos, don't hesitate to leave a comment below. I love getting the feedback. I love making these videos. It's fun. It helps me. And, I'm having fun doing it. So anyways, thank you. Have a great weekend. Hope to see you soon.